G'day and welcome to the Investor Motivation Podcast. Welcome, Amy.
Hello, Rob. How are you?
Going well, thank you.
Good.
Friday afternoon,
It
and it's been a big day. Had an awesome conversation with Arvid Streimann from Magellan Global Fund today. So that was, really intriguing conversation. A lot of value that we've got out of that, and I hope you do as well. So a bit about Arvid. He's the co-portfolio manager of the global strategy at Magellan Financial Group. He's been doing that since 2020, and he's been with the business, joined in 2014, and has worked at Morgan Stanley, at the Reserve Bank and UBS. So 24 plus years experience in managing money. So I think someone who's very well qualified for the job.
Definitely.
Then we had some really good conversations and covered off a lot of the, some important businesses. We covered off Apple, we covered Google, Microsoft, artificial intelligence, the semiconductor business, a lot about China. We really covered off a lot of
a lot of topics there.
A lot of topics, and also
I've been most of it with him.
Yeah, like I've been asking Emma Fisher from a previous podcast, which I'd recommend, if you want to go and see a very highly intelligent person. Emma is fantastic to listen to, but I've asked them, what learnings they've taken out of the study and research that we've all done on Warren Buffett. What is their key learning? So Arvid, gives us a little bit of gold around that as well.
Yeah. But before we get into all of that, I will go through the acknowledgement of land. On behalf of the Investor Motivation Podcast, I would like to acknowledge the traditional custodians of the land on which we record this podcast and pay our respects to the elders past, present and emerging.
Fantastic. Thank you, Amy. Stick with us. Goes for a bit under an hour, but Arvid is very engaging, and as you said, Amy, I did take the opportunity to have a good opportunity, threw a lot of questions at him.
Pick the brains of all these people much smarter than I could ever attempt to be.
That's right. We're on our way, Amy, I'm sure. But it's a learning process, and that's something these people are very passionate about what they do. This is not a job for them. They actually like what they do, and that shows in the work and the knowledge that they've got. So please enjoy, and I'll see you in a few moments with Arvid.
Yeah, get into it.
Welcome to the Investor Motivation Podcast, and absolutely delighted to have Arvid Streimann from Magellan Financial Group, who is in charge of one of the people in charge of the Magellan Global Fund. Welcome, Arvid.
Thanks, Rob. It's great to be here with you today to have a chat.
Yeah, it's been a very interesting 12 months, and particularly globally, and particularly tech businesses have probably done it a bit tougher than anywhere else. So we'll jump into some of those conversations. But the first thing I was keen to ask you about, your passion for investing, where did that come from?
Yeah, I think that my passion for investing really came from when I started in university. I had some friends there who were quite keen investors. I think one of them was one of these super smart people that has a TER or an ATAR of 100, and he got a scholarship, and he was investing that money. And so we started thinking about the markets together, and I was lucky enough to, once I'd graduated, move to the Reserve Bank, where I was looking at the share market as part of my day job, which was great. And I was doing some trading there. Of course, back then you could do a little bit more trading than you can now at the Reserve Bank. And I quickly found out that the Reserve Bank, although it was interesting, it wasn't really what I wanted to do. And I moved into investment markets, and I think it's really important that people do what they're interested in, hopefully in their job as well. And I'm lucky enough to do that. So I think that's more or less where it came from. I think I remember looking at the financial pages when I was quite young as well, and sort of wondering what the heck they all were as well. So I think there was a natural curiosity, and I think the financial markets is kind of unique, and investing is kind of unique, because it's very hard to master it. Okay, it's one of those things where you're continually learning, because there's always new stuff that's happening, and I think that's attractive as well.
And obviously the curveballs that the market sends us all the time is just it's part of that learning process.
Yeah, and it's interesting, right? It's really interesting. So yeah, you're exactly right.
Yeah, and just when you think you've nailed it, the market will whack you across the head and say, no, you're still learning.
Yeah, or maybe there's a global pandemic and the world goes haywire as well. So there's always something to think about.
Absolutely. So I'm quite interested in, obviously, I've been a follower of Magellan for over a decade, and watch the direction Hamish has taken it from a investment process, and the way that he communicated a lot of the strategies and the sectors and the business that he likes. Would you be able to go through what the process looks like now? Has it changed? But what is the process from identifying promising sectors, businesses, through to investment?
Yeah, sure thing. So it sounds like there's a couple of questions there, whether the processes have changed and what actually is the process. So the first thing I'd say here is that the investment style and the investment philosophy hasn't changed. Okay, and we're looking at and our performance and what decisions we make and why we made those decisions and when they work and when they don't work. And that's within the context of the investment philosophy and style. And that investment philosophy and style we also look at and wonder whether it's working. I think that you should always do this, by the way, even if you think it is working. And we've never come to the conclusion that it's broken. So that's why, in answer to your first question, the investment philosophy hasn't changed. But when you're thinking about the investment philosophy, maybe I'll go into that because it's really interesting, I think. So what we do is let's just start with the world and the thousands of stocks that are out there. So I think as an investor, you have to think about how you want to look at that world and how you're going to choose. And what we do is we do a couple of things. Firstly, is we look at quality companies, and we're trying to find those companies which have the necessary level of quality. Okay, and there are many companies, and most companies in the world would fail our quality test, by the way. And if you think about the thousands of companies that are out there, only around 200 or so pass our quality test. And what I mean by that is we have an internal investment committee which more or less rubber stamps or approves what stocks that we can get in. Of course, it's not a rubber stamp, but there's actually quite a lot of debate which comes into this. But we approve the stocks which are of sufficient quality, which get into our investable universe. And there's a committee which is tasked with doing that. And so that just gives you the pond you can fish in, so to speak. And I think the end point, of course, is the portfolio. So what happens is that we're always thinking about, okay, quality is one thing, but there's also the attractiveness of the company, right? Whether it's an attractive valuation or maybe there's a thematic that's quite attractive and the balance of risks in the long term is to the upside. And so of those 200 companies, we narrow it down to, let's call it 50 or 60 or so companies, which are most of interest. And then we're looking at those ones, and we've got a team of almost 30 people in the investment team, which is quite big. And their job is to look at those companies and figure out and they're all high quality, which ones are the most attractive, okay, out of the very good, which are the very, very good. And that's how we end up with the portfolio, which is 20 to 40, let's call it around 30 on average. It's really a focus on those companies where we have the highest level of conviction in a few things, I would say. The highest level of conviction in the quality, the highest level of conviction in the attractiveness of the valuation, so the prospective returns. And then the third one is the highest level of conviction that when you put in all of these companies together, you're not having too much of one risk, because you wouldn't just take, let's say, your top 5 companies and just pick those, because they might all be the same type of company, for instance.
Yes. Yep. And Arvid, you said there's an investment team of 30 people coming together, and obviously those 30 people have all got their own opinions and ideas. What's the process in a very big meeting to distill this down to get to those 10, 15, 20 different businesses?
Yeah, it's. I think what you're getting at here, Rob, is communication and idea generation and idea swapping, and this is something that I think is really important. And the way that we do it here at Magellan is we have regular meetings, because I think that people still, do like to speak. I think that's a very effective form of communication as opposed to writing, which is a little bit more distant. So I think speaking, because you can have the two-way conversation, in a quicker format than writing, is very effective. And we have regular meetings with the entire investment team, which is approaching 30, and then also with the sector teams, which is a little bit more of a focused group meeting, looking at more specific companies, particular types of companies, and that has to be a two-way conversation, and it has to be, I would say, an informed conversation. So what I mean by informed is it has to be a conversation where people have brought their A game so to speak, and brought the good ideas, because it's less interesting to talk about bad ideas, of course. And then they have the two-way feedback, which I think is important as well, because I think in terms of running a team, I think the people who are let's call them the managers, want something from the people who are, let's call them the analysts, and the analysts also want something from the managers. They want feedback as well. So I think this is kind of important too.
Yep. Let's just focus on some of those bad ideas, which every portfolio and the investors that's having a go will always get their bad ideas that currently live in our portfolios. How does Magellan go about, I suppose, analysing those to say, well, is there a future, or at what stage do we cut our losses and move on?
Yeah, okay. So if you're thinking about a stock that's in the portfolio, I think there's a couple of reasons why you might decide to move on. Okay, one is something happens to the company, and we're talking about companies here. Something happens to the company where you go, I think the earnings outlook or the profit outlook has permanently changed down. Okay, not changed down for a quarter or two, but permanently changed down. And you kind of see this all the time. And when that happens, typically a share price falls quite a lot. Okay, so that might be confirmation that something's happened. But share price falling quite a lot doesn't necessarily mean that there is a permanent change as well. So I would say if there's a permanent change down in the profitability, and there's a few ways, or there's many ways that could happen. There could be disruption. And the example I always like to give here is, let's just say Kodak was making a lot of cameras at one stage with film, and then all of a sudden there was this electronic one where you didn't have to go and get your film developed, and that was, very nice to do. So Kodak's not as profitable as it used to be. Let's put it that way. Another thing is that if you might just get a competitor come in, and one company that we held in the portfolio up until recently, which is Meta Platforms, which is the old Facebook, they were of course facing a lot of new competition and very strong competition from TikTok. And there wasn't much they could do about that, because when Facebook was facing an emerging threat from Instagram, they bought Instagram, but of course they couldn't buy TikTok because the regulations are a bit higher or a bit more stringent. But I think the third one I would say here is when regulations sort of change to the downside for the company. And I always like to say, when regulations come in, they're typically not good for profits. Okay,
Right.
And the best example here, or a really good example, I think, is the banks after the GFC. Okay, they got heavily regulated, and I think their profitability, particularly the ones in the US, the big investment banks, they haven't really seen that much. The profit growth has really been hurt. Another thing I would say here is when you might want to sell a company or exit a portfolio is the valuation has just moved to where you think it should be. So maybe your thesis has played out. You always thought it should go, the share price should go up for these reasons, and it plays out. And I think you have to be honest with yourself and say, well, I was here for this reason, and that reason's happened. So maybe there's less reason to be there, or maybe it just gets overpriced as well.
And Arvid, does Apple, for the Magellan Global Fund, fit that bill a bit in the past, where you guys have owned it a long time ago and it went up, and I think there was a reduction in that holding, and I notice it's still in the portfolio. Is that sort of Apple being that type of business where it has done what you achieved, but then you weren't happy with the valuation at certain points?
Yeah, so Apple's a really interesting one, obviously a very successful company. I think that with Apple, the I would say the greatest attraction with Apple is the ecosystem which they have. Okay. And it's kind of hard to get out of the Apple ecosystem. Okay. And I would say that when you're looking back over our holdings, I don't think that we really had that much concern around the ecosystem and its durability, but more as you say, the valuation placed on that ecosystem and its ability to, let's call it, harvest and monetize that ecosystem. So it's interesting because you're using the same language which I used before, whether it's a change in profitability outlook or just a change in valuation. And for Apple, it was really a change in valuation. But of course, the other thing I would say here is when you're constructing a portfolio, and Apple, of course, in being a tech company, it's like most tech companies, especially the big ones, it's facing regulatory risk. So you've got to think, if you've got a lot of tech companies in your portfolio, independent of those other things we talked about, maybe you don't want so much regulatory risk. And so even if a company is attractive, you may not have it in your portfolio because you may be having too much of regulatory risk or some other risk in your portfolio, and you might want to just shape the portfolio to control that.
Yep, fantastic. Thank you. Just want to circle back around, obviously, identifying promising businesses and obviously quality, that top 200 out of thousands that meet your quality criteria. What the key points in quality? What are we looking for? Obviously, profitability is one, but I'm sure there's a larger list.
Yeah, so when we think about quality, and this is, I'm letting you into the house of what happens in the investment committee here. When we're thinking about quality, we're really thinking about 4 types of attributes, I would say. The first would be an economic moat. And you can kind of think about your economic moat not being so much about how profitable you are. Of course, we're looking for the more profitable companies, but how durable that profitability is. Okay, so when you think about economic moat, it's the moat around your profitability, not the level of profitability per se. And obviously, you want a wider economic moat. And we, in the investment committee, we look for and score companies on their economic moat. And by the way, some companies don't have an economic moat, and they don't make our 200. The
Yes.
second would be business risk. So this is another thing that we look at, and we're looking at the forecastability of the cash flows of the company. In some companies, it's hard to forecast the profitability of cash flows for various reasons, and that would be lower quality for us. Another
Yep.
one, let's call it number 3, would be what we would call agency risk, and that's more or less, are the management team acting in the best interests of shareholders? Because you see a lot of management teams who don't do this, of course, and it can be quite a bad thing for share prices. So of course we look at that as well. And then the last thing would be what we call reinvestment potential. So let's just say you reinvest another $1 in the business. How much additional profit does that generate? And we obviously want companies who generate lots of money from that extra $1, which goes to scaling and all of that sort of stuff. So when we're thinking about quality, it's all of those 4 things. And of course, in the investment committee, we debate these and score them. And it's actually a fun process to go through.
Yep, it does sound like fun. Just a really broad question around, obviously, just your thoughts on the current global markets. We've seen a lot of volatility, and I'm definitely not after a short-term prediction of what may happen, but just, I suppose, what your thoughts are and where the risks still lie.
Yeah, sure. So this is like fascinating, I think. And if I was to use one word to describe the state of the global markets at the moment, I would say they're incredibly interesting. And the reason is, if you go back in history, there aren't many times that you can think of where you've had something as globally momentous as a global pandemic.
Yep.
Then massive stimulus. Of course, the stimulus that we had, which was globally coordinated, by the way, was off the charts if you think about it relative to history. And then, of course, you've had a 40-year high in inflation, and then you've had an incredible rise in interest rates, which, of course, is making the news every day. So what to make of that, I think, is really interesting, because that movement higher in interest rates, it scared the pants off a lot of people, if I could put it that way, because people were used to 0 interest rates, which, of course, was something which we hadn't seen before for many, many, many years. And then it quickly got away from 0. So the markets, I think, were very edgy, and is still very edgy with regards to the interest rate outlook. But I think what's going to happen here is that we know why interest rates are going up, which is to slow inflation and growth. So I'm pretty sure that what's going to happen is that growth is going to slow, and therefore profits and profit growth is going to slow. And so when you're thinking about global markets at the moment, I think there's a transition going on from what drove markets last year, which was higher interest rates, and you really saw some of the more speculative types of companies which are more sensitive to higher interest rates underperform. But this year is going to be more about, can I find those companies where the earnings durability is there? Okay, and I think this is more or less going to be the key issue, or the key emerging issue. But it's interesting when you're not after short-term predictions, but maybe I can give you a flavor for what we're thinking about the market right now. So if we look at market valuations, and we all know that market valuations can be impacted by interest rates being the gravity of markets. So you can adjust market valuations for interest rates. it's hard to do perfectly, but you can get, let's call it 90% of the way there. And if you do that, these adjusted valuations are actually really high, okay? And you go, okay, so what is giving people the confidence to have very high P ratios adjusted for interest rates, very high relative to the last, let's call them 40 years?
Yep.
And the answer is, I don't know, okay? I think people are just being a little bit too optimistic. So maybe in the short term, the balance of risk is a little bit to the downside because of that. That's a debate. But I think over the medium term, if I could leave one thing with you, it's over the medium term, let's just define the medium term as once we're past this interest rate going up phase, interest rates will be, let's call them 4%. Okay, they're kind of 4% now. Let's just say they're 4%. If you look back from 2000 to, let's call it the start of 2000 to the end of 2019, interest rates fell, and you can estimate the contribution that made to equity returns. And it's about 3% a year, okay? And you go, okay, well, that's pretty, I wouldn't mind an extra 3%. Now, I'm not saying that that's going to happen again, but if we're at the top of the interest rate cycle in the medium term, then maybe you can get a small headwind. It's probably going to be less than 3% a year. But if you're thinking about investing over the more medium to longer term, I think interest rates could go down again, and you're going to get almost the opposite of what you saw last year. So I think over the medium term, I'm much more optimistic than, let's call it, the very short term, which of course is harder to forecast.
Absolutely, but obviously at this point in time, despite the volatility that we're seeing and the concern around the place, and that's the one thing I notice when I'm talking to my clients, Arvid, is that there's more anxiety now around markets, and probably the media is not helping with that. Of all those things you mentioned around pandemic, inflation, interest rates, and then throw in a war as well. The investors are more concerned now than what I've seen them, even perhaps during the GFC. There's a bit more anxiety than what there's been in the past. But I suppose, over the next 5-10 years, a lot of the businesses that you invest into are still heavily reinvesting back into their business to grow for the future.
Yeah, so a couple of comments on what you just said, Rob. So, the media, I would say, I always tell people, if you watch the 6 o'clock news and you write down, okay, so they talked about 10 stories, I would say like 8 of them are negative every night. Okay, yes. So the media tends to have a negative bias, and I think that people react to that negative bias. And I think that people, particularly in Australia right now, are feeling the pinch of higher interest rates. Okay, and there's also this roll off of the fixed rate mortgages, which is kind of happening right about now as well. So I think people are naturally feeling a little bit less confident than they were before. And of course, you throw in the war and the stuff that's happening, which seems to be happening between the US and China, which we may get dragged into as well. I think there's a lot of reasons to be a little bit sort of cautious, and I think you kind of feel that. But I look at that and I go, when people are really worried, that's the time to be most excited as an investor, okay? And when I was talking earlier about the short-term outlook, and I kind of hinted that it looks as though people are a little bit too optimistic, then I kind of think you might want to take the other side of that. And when people get too pessimistic, and that's reflected in asset prices, you probably want to take the other side of that. And with respect to your second point that you were talking about, Rob, with companies that are investing, I would say that one of the things that a high quality company does is exactly what I just talked about, which is lean against the prevailing, let's call it pessimism, because and you see this all the time with companies which win over the longer term, when, let's just say, the economy's heading south and businesses cutting costs, those companies which look through the cycle and say, I know everyone's cutting costs, but we're really going to reinvest now. We're going to up our marketing budget. We're going to up our product development. They typically win all of that back plus more, because their competitive position is much stronger, and it sets them up for let's call it a 10-year period, or however long you want to think about it. And so I would say that what you described is a very strong indicator of quality and very strong indicator of management and good strategy as well.
Fantastic. Arvid, you mentioned China in there. I know you're thinking very broadly from a macro point of view about obviously China and US relations, and obviously China's been a tough investment place for Magellan and other investors for quite a number of years. But one thing that Magellan's often spoken about is the the growing middle class in China, and they're reopening at the moment. And sure, that investment thesis has not gone anywhere. But obviously the joy of owning Tencent and Amazon, that shines off on all that. How's Magellan looking to benefit, from the opportunity that still is China, without perhaps having direct exposure?
Yeah, so and that's a very good question, and I like how you frame it with the direct exposure too, because this is kind of how we think about it. So if you're going to invest in Chinese and a Chinese exposure, you're taking a bunch of different types of risks. You're taking the economic risk, and so at the moment you might say that economic risk is a positive thing. We kind of want that, okay?
Yeah.
But then you get the political and regulatory risk, which I'm pretty sure most people don't want at the moment, okay? And so there's a bunch of risks that you're going to get, and you're trying to maximize one and minimize the other. And investing in China's growth outlook, but not in a Chinese company, is one way to do it. Because we do like the reopening trade in China. I think it's going to be big, and it's interesting. These things tend to last longer than you think. Okay, so it's interesting from that perspective, and of course the political leadership is behind all of this, so it's got political air cover as well, which is always a good thing. So the economic side is really interesting, but the regulatory side, I'd say, is still uncertain. And a lot of people are saying, well, the Chinese regulatory risk has really gone down. I would say it hasn't gone down, it's stabilized at a high level, okay? And what's really interesting is that people were always, I think a lot of Chinese companies got really cheap because people saw that the profitability was getting hurt by the government, but they were also uncertain as to how far that would go. Now they know where it's gone, okay, which is lower, and maybe the Chinese government's got a board seat, which of course typically isn't very good for profitability. But it's the point I'm making is that the fact that you've got less uncertainty doesn't mean you're in a good spot. Okay, I think we've got less uncertainty, but we're confirmed to be in a kind of a bad spot. So the way that we would attack this problem is, as you say, invest in Western companies that are investing in China. Okay, and I think there's a couple of things you've got to be careful of here. One is you have to be investing in companies that don't annoy the Chinese government. So investing in Lockheed Martin or Raytheon, which are big defense companies in America, if they had a Chinese exposure, which they don't, that would get cleaned up by the Chinese government or knocked on the head pretty quickly. So you want to be in industries in China which make the Chinese government happy. So that would be the first thing I would say. The second thing I would say is that you want to invest in companies from countries which China is less likely to not attack, but put sanctions on. Of course, in Australia, there were Chinese sanctions. Yes. And here, I think we can all observe that the Chinese government has been reluctant to really go after American companies. Guess why? Because America is a major trading partner. So you can kind of understand that. And you've seen that China's gone after Australia, it's gone after some Swedish companies, it's gone after some South Korean companies, largely because they have less economic clout and less diplomatic clout. So stick with those companies which are domiciled in countries which have economic clout and diplomatic clout.
Right. Yeah, there's a bit of a contradiction. Obviously, there's probably no bigger antagonist to China than the US, but from a monetary point of view, that takes precedent. And I think I've learned recently that a lot of the barley or certain agricultural commodities that we were sanctioned on, America was the one that filled the void and took that market on us. So I was sort of a little bit flawed because of that. But obviously, back to some of the holdings on that theme, LVMH is the French business. Obviously, you don't have any concerns between China and the French having cracks from a sanction point of view at each other.
Well, I think that you have to have concerns with all Western companies, perhaps seeing their companies and the countries which they're operating, having their relationship with the Chinese government deteriorate. I think that this is a risk that you have to say is non-zero for everyone, but you have to say and make a judgment on who's got the higher probability of getting on the wrong side of the government. And when we think about LVMH, let's apply this test or the framework which I mentioned before, which is look at what they provide and also look at the country which they come from. So let's look at what they provide. Well, they provide luxury goods. Not, I think they're all expensive, but they're not the $10 million handbags or anything like that, which was very ostentatious. And
is that a thing? Is it, Arvid?
Well, I've never seen one, and luckily my wife's never bought one either. But my point is, it's not at the ultra luxury end.
Yes.
And even though Xi Jinping is trying to crack down on, let's call it, ostentatious spending, the other side of that is that as you have your citizens get more wealthy and higher income, they aspire to have some of those things. Okay. And so I think the middle ground here is to invest in a company which is providing luxury because people want it, but not too expensive. Okay. And I think this is the position that they're in. I like to say you probably don't want to be selling jewel encrusted Lamborghinis in China right now. Okay. Because that's quite ostentatious. With regards to the country that they're from, France, I think is obviously a powerful player on the diplomatic and global diplomatic stage.
Yes.
But the other thing I would say here is that the major shareholder, one of the major, the founder of that company, is one of the richest people in the world as well. So if you're China and ultimately what you're trying to do is maximize your global diplomatic clout, he's probably one person that you want in your good books.
Right. Well, I suppose another company in a holding for the Magellan Global Fund has been Starbucks over the time, and obviously there's risk there between China and the US. Yeah, where's your position at, and in terms of the holding in the portfolio, and your thoughts on the risk for Starbucks?
Yeah, so Starbucks wasn't in our portfolio when we last made our disclosures at the end of the year.
Okay.
So obviously I can't tell you what's in there now, but I'm not hinting anything either, by the way. But Starbucks, it was in the portfolio and then we sold it. And the reason why was a couple of things. Firstly, the Chinese economic outlook, as the global outlook did during COVID, deteriorated. And a lot of the valuation in Starbucks was driven by the massive growth potential coming out of China. So their store rollout was a large part of it was coming from China, and a large part of their profit growth was coming from China, which means a large part of the share price was driven by what's happening in China. So when the expansion in China looked as though it was going to be slower than it was going to be because of what was happening with COVID, but also as well as the trajectory coming down, the uncertainty around that trajectory widened out a bit as well. That goes to valuation and certainty and lower level of conviction. And so given where the valuation was and that I would call changed outlook for profitability and lower conviction, we decided to sell it. And I would say the other thing that happened here was there was a very big change in management as well. So at the same time, so there was a confluence of factors, I would say.
Fantastic. Yeah, just changing tack now a bit to so an issue that's quite topical, and that is artificial intelligence. And obviously that's been a key theme across the portfolio for quite a while. But obviously OpenAI's Chat GPT, and the active risks for Google and search, which is obviously the main part of its business. And I noted that Google's position in weighting in the portfolio has come down in recent times, but it's still there. So you obviously have a very active, I suppose, thinking very deeply about some of the risks.
Yeah, and it's an interesting one. We'd like to think about all the risks, and this is one which has got a lot of attention. Here's what we're thinking about this at the moment. So I'll make a few comments. The first is the reduction in our Alphabet, the parent company of Google, the reduction in the Alphabet weighting within the portfolio, not due so much, just for complete clarity here, not due to the AI, potential AI threat to its internet search business, which of course is a very, very strong business, which makes lots of money. It was more due to the fact that as interest rates go up, tech companies, because of their longer growth profile, tend to underperformed the market. So I would say that's one of the reasons why tech as a whole has underperformed the markets, as interest rates gone up, and we kind of pre-positioned for that. The other reason why the Alphabet, we trimmed Alphabet, and we have been trimming Alphabet, is because if we're thinking that the world is going to get into this slowdown, which of course the Federal Reserve's trying to do, and I wouldn't fight the Fed on that, by the way, then we're thinking about, well, what are the most cyclical parts of the market? And advertising, of which digital advertising is a large part, is inherently cyclical. So I would say they're the more of the reasons that we trimmed. But when it comes to AI, I've got 2 more points here because I said 3. So point number 2, when it comes to AI, you've got to remember that so Microsoft's got a stake in OpenAI, which owns ChatGPT. Alphabet has been for many years the leader in this type of AI. Okay, and some of their employees actually wrote some of the seminal pieces of work which created or were the basis for ChatGPT. And Alphabet has not stopped investing in this technology because it knows that it's quite a valuable thing if you get it right. And so that gives us confidence that they will not be far behind, if at all behind, what's happening with ChatGPT. Now, they weren't first to market, okay, in a long way, in the way that we've seen, but that doesn't mean that their technology is lagging. It just means they didn't put it out first. And all of these leading edge technologies, they're always a little bit buggy when you first put them out. Okay, and I think Alphabet was, Google was criticized for its AI when that happened. But by the way, the same thing happened to ChatGPT. But the point being that I don't think that Alphabet's really behind the game here. But when we're thinking about, this is the third point, when we're thinking about what it might mean, obviously it may disrupt, and we talked about disruption earlier, it may disrupt the internet search industry, and that means that it may disrupt Alphabet's profit outlook. But when we think about what actually that means, does it mean the market share will change? Because, by the way, Google's web search, the traditional internet search, is, the numbers tell the story. It's better than Bing's, okay? Based on public usage. So would that really change? Maybe. Would profitability change? Well, we know that there's additional computing power and resources which need to go into, this ChatGPT, the dialogue that you have with this thing. So maybe it's a margin thing more than a market share thing. But then you have to go, well, how long do you think this is going to take? Because we are in very early stages of this. So I don't think it's tomorrow is the point that we're going to all be chatting to AI assistants on our mobile phones or something else. So I think this has got a bit to play out. And the key point, I think, is that the investment markets seem to have, as they do, if you remember back to the dot-com bubble, you would have seen this as well, they tend to over-extrapolate things as well as under-extrapolate things when they're negative. And I would say that on average, given that everyone's talking about ChatGPT, they're probably overestimating how quickly these things become material. But we'll see.
Right, and overestimating how far behind, obviously, Google and their chatbot Bard is behind. Obviously, they've been working on this for many years, and driverless cars or AI is nothing new to Google by a long shot.
Yeah, and as I said, just because you were first to market doesn't mean that your product is the best. And the other thing here is that you go, okay, so there's always a first mover advantage, okay, from going first. People are talking about ChatGPT because they went first. But that doesn't, firstly, it doesn't mean that the product's better. We'll see where Alphabet lands on this. But secondly, when you see in all industries someone take that first mover advantage, it may not always be a durable advantage. And what I mean by that is you can, in many industries, and you see this, you can successfully be a fast follower. So you can be the person that comes in second or third, but do it quite quickly. And you can kind of think about cutting a trail through the bush. The first person does all the work and is pushing all of the sticks out of the way, and the second person just sits to walk through there. So without doing all of that hard work. So what I'm saying here is that it's still an open question as to how this plays out, and going first doesn't necessarily mean you're going to win in the longer term.
Yep. Just pushing our focus towards Microsoft, its biggest holding in the portfolio, and obviously, we're recording this on Teams. There's a monopoly in the way that we do business, the way we communicate. It's one of the best businesses in the world. I suppose, are there any competitive risks that we need to be thinking about with Microsoft? It just appears to be an amazing business. Every time we log on to our Word or Excel or Outlook or whatever program that we use on a daily basis, they just seem to be improving it and keeping the foothold on us. Are there any risks there? Are there any competitors in that space?
Yeah, so I think you always need to think about what the competitive risks are. Okay, so I think you're onto a good thing there. What I would say about Microsoft and its ecosystem is a bit like the Apple iPhone ecosystem or the iPad ecosystem.
Yeah.
It's the reason why it's an ecosystem which has lasted is because it's hard to escape. Okay, it's a bit like Alcatraz. People didn't escape because it was hard to escape. Okay, and so what that means is we would put a large economic moat around that. And so there are people who are trying around all of Microsoft's businesses, and it's not just the Office with Teams that we're on, but it's also the cloud business, which we're incredibly excited about.
Yes.
But there's always going to be that competitive threat. And so when we're thinking about, well, how successful is a potential interloper going to be, it seems quite hard. Okay, and so that gives us the confidence. One of the reasons why gives us the confidence and the conviction to make it our largest position, because it is quite a hard thing to do. And the other thing I would say here is that, and it's similar to what I was talking about before with larger businesses. Once you're a large business, and Facebook was like this when it had Instagram. If you're a large business, you have all of the resources to do what those other people are trying to do as well. Okay, so. Yes. That reduces that threat of interlopers and disruptors. And by the way, and maybe this isn't entirely appropriate for Microsoft, given they're in the tech space and there's a bit of regulatory oversight, but it is common in a lot of industries for an emerging competitor to be swallowed up by the incumbent. Now, that goes to antitrust laws and all that sort of stuff, and I'm making the point rather than a prediction. But all I'm really saying here is that if you have scale, it gives you a massive advantage against potential disruptors.
Yep. In a practical sense, when we first subscribed to Office 365 and got exposed to the whole suite of all the products, in a practical sense, as a business, we were able to get rid of 3 separate subscriptions. Just straight away, thought, oh, gee, Microsoft do that as well. At what point do governments get interested from an anti-competitive point of view, where they say, hold on, you just can't smash everyone?
Yeah, so this is an interesting question, because I think my framework for thinking about the government is they're a political entity. So you have to think about the government's response in terms of how many votes it's going to get. Okay. And when you use that framework, businesses don't vote, but households do, if you want to kind of think about it that way. So what I'm saying is you have to annoy households as opposed to annoy potential business competitors to Microsoft or anyone else. And so the question then is, well, and this is largely the test in antitrust cases, is, well, what's the consumer harm? Okay, what's actually happening here, which is going to reduce competition, increase prices, reduce technological progress? Can you prove that that's the case? And so that there shouldn't be more that this M&A thing shouldn't happen. And so that would be the framework. And so I guess where I'm going with this is it has to be a case by case type of thing. And what I would say is that if you're thinking about an industry and you're taking all of the competitors and you're ending up with 100% of that industry, you're more likely to fall afoul of the regulator. But if you're Microsoft and then you're adding a new business over here, which isn't in the same industry, but it's in something similar. So let's say it's a cloud business. Microsoft Azure as opposed to Microsoft Office, which is, it's got some synergies and some relationship with that business, but it's not the same thing, then I think that's what we call horizontal mergers. That would be an easier thing to, get across the regulator. So I would say when you're thinking about these threats of regulation, think about what type of merger it is and how much it's going to annoy voters, because no politician wants to annoy a voter.
Okay, and I suppose thinking about the acquisition of Activision Blizzard, the gaming business, I think it was a $69 billion transaction. What's your thoughts on that? Will that go ahead?
Yeah, I think I think, okay, let's put this into two places. Two things. Firstly is, why did they do it? And the secondly is, according to that test, which I just said, let's make some observations, maybe more than a flat out prediction. So I think it's interesting from Microsoft's perspective to get into gaming, because obviously gaming's something which is becoming more popular, esports and all this sort of stuff, and it's a form of entertainment as well, by the way. So it kind of competes with TV and traditional media consumption things that people do. So I can see why they would want to do it. And by the way, if the metaverse becomes a thing, which of course that Mark Zuckerberg down at Meta Platforms, the old Facebook, is trying to be a first mover in, then having an exposure to gaming and maybe inventing the goggles, and it maybe gives you an advantage, maybe gives you a position or an increased likelihood that you will be in that position which Mark Zuckerberg is going to be in. Okay, so I think this is interesting from that perspective. From a perspective, if the second question of what's the likelihood or the issues that may face from a regulatory perspective, of course, the consumer harm piece comes in, and Microsoft already has some presence in the gaming industry through Xbox, of course. It owns the Xbox things which you attach to your TV. So the question there, which the US authorities and European authorities will look quite closely as is to whether that triggers a level of market consolidation which is too far. And that's something which we could debate all day. And it's interesting because I always say to people, one of the things that you shouldn't do is when you're making predictions about what you think someone might do, is think about what is to make a conclusion based on what you would do. You got to always say, well, it's the regulator I'm trying to predict, so I'm trying to predict on what they are going to do. And that's a source of massive amounts of column inches. And I wouldn't say that I've got a high level of conviction on what's going to happen there. But I think that if it does go through for Microsoft, then I think that would be a positive.
Yep, fantastic. Sticking with tech businesses, a new holding the portfolio, ASML, based in the Netherlands. I'd love an explanation and the investment thesis for that. It's a very large business, but doing some unique work.
Yeah, so this is kind of interesting for a couple of reasons. The first is, if we think about one of the, let's call it mega trends, one of the things which is going to be a structural growth thematic over the next, let's call it 10, 20, 30 years, I think that one of those is digitization. Everything's being digitized. And what that means is that digitization and all of the programs are built on semiconductors. And the Internet of Things also is built on semiconductors. So semiconductor demand is going to grow very strongly, okay? And so when you're thinking about getting exposure to this very strong structural trend, you got to figure out what flavor of exposure you want to get, okay? And there's a couple of, there's many parts of the semiconductor market, and I think they all have their attractive features and less attractive features. But what ASML has is that attracts us is that it has a near monopoly position in some of these most advanced machines which make the semiconductors. So to be clear, it doesn't actually make semiconductors, it makes the machines which make semiconductors. So a semiconductor factory or fab plant, the fab owner will buy the machine from ASML, and then start making the semiconductors. And it's almost, as I mentioned, a near monopoly here, which means that if you want to buy one of these things, you've got to get in line and take a ticket, right? And if you look at what's happening, that's exactly what people are doing. They're taking a ticket, and it's like when you used to go to the deli at the supermarket, you take a ticket and you line up. And so the backlog of orders that ASML has for these machines is really big, okay? And this brings me on to the second point, which is, well, why is it really big? Well, I know that they're a monopoly, but why is this backlog really big? There's obviously the semiconductor super cycle here. And the reason is because most of these machines and these fabrication plants are in Taiwan, which there's a lot of debate as to what might happen to Taiwan. And we work in portfolio management, which is risk management. The people in the US government are doing their own risk management, and they're saying, well, we'd like our own fabrication plants. And so we have to call up ASML and get in line, essentially. And of course, the American government is spending billions of dollars to do exactly this. And so the other thing I would say here is that let's just say something happens with regards to China-Taiwanese relations. I would imagine the first thing that happens is that the US government and the Japanese government and the German government, they're going to say, oh my gosh, my potential supply of semiconductors, which I really need from Taiwan, has just become more risky. I need those machines now. Okay, so it's almost a hedge on what might happen with regards to Taiwan as well, which kind of makes it interesting.
Yes. Fantastic. Thank you for that. And I think it's worth noting, I've gone on to YouTube and have a look at ASML's videos to try to understand the technology, but it's just so complex. And obviously that's part of the big moat that is around ASML as a business. Their technologies are massively complex and hard to replicate.
Yeah, and it's interesting because, of course, the Americans are trying to cut China off from a lot of these technologies and ASML's technologies as well. And so the debate is, how long does it take China to do this themselves? And this is a question we ask our experts and the people we talk to all the time. And there's a range of responses they give. But a lot of people say that you'll never actually catch up to the cutting edge. You'll always be some years behind, no matter how much money you throw at it. So yeah, it's everyone finds this very complicated.
Yep. Fantastic. Last question. Over the years, obviously, there's no doubt we are all students of Warren Buffett, and Hamish has quoted him over the duration. I'm keen to know, what bit of information or learnings from reading Buffett's books and annual reports that has had impact on you as an investor, Arvid?
Yeah, well, there's many, of course, but I would go back to one of the things that I was saying earlier, which I think is really simple, but it's one of those things which feels uncomfortable at the time, which is when markets are really ramping, and let's call it because risk premiums are becoming very low. So there's a lot of strong sentiment, positive sentiment.
Yes.
If things go too far, and there are always signs that things go too far, we can discuss what those signs might be. But when things go too far and people are, as Warren would say, people are getting greedy, maybe you should be fearful, okay, and vice versa. So we talked about that earlier. Maybe you want to lean against sentiment when it gets a little bit out of whack. I think that's very profound, and I'm not trying to say that you should do this every day, but if you look at markets over time, you can see bubbles and manias and pockets of the market which get out of whack, and if you just want to avoid those, and you saw them after the COVID stimulus in parts of the equity market, I would call in particular the speculative tech part of the market, but also in parts of the crypto space. I think that there was a little bit of this going on, and then of course you saw it also in the dot-com boom on a much larger scale. And so you just think of what your returns would be if you just avoided all of the almost inevitable unwinds of those things. Okay, and of course you can, when things get very cheap, and you lean into them as well. So I think that understanding the market psychology and leaning against it, and of course it feels uncomfortable because people will argue that you're wrong. But sticking to that framework, I think everyone should always have a framework, I think pays dividends in the longer term.
Yeah. So essentially, partly Arvid talking about a healthy dose of patience To recognise when a market may well be in bubble territory. Would Schiller's CAPE ratio, which is freely on the internet, is that a nice broad way to have a look at valuations of markets as a whole?
Yeah, I think so. We look at a lot of things when we're trying to determine the level of valuations, and essentially what we're trying to get to is the price of risk. Okay, so
Yep.
for a level of risk, how much are you paying for that level of risk? Okay, and sometimes that can get very expensive, and you might think it's a bit too ritzy. But you reference the CAPE ratio. That's one of the things that we look at. We
Yep.
look at the normal PE ratio. We look at the normal PE ratio and adjust it for interest rates. We do a lot of things, but I think it's a bit like life. There's no silver bullet for everything. I think you need to look at a bunch of things, and if 80% of them say something's out of whack, then there's a signal in that, I think.
Yeah, fantastic. Well, Arvid Streimann, thank you so much for spending some time with us today. Really appreciate it, and fantastic insights, and love the passion you got for your job and your hobby.
Well, thanks for having me on. It's been a very enjoyable chat, Rob.
Fantastic. Thank you, Arvid. We'll
Cheers.
catch you next time. Bye.